Hello, I'm Tony Kaye, I'm the editor of InvestSMART. Welcome to today's advisor Q&A session. As always, we hope you can tune in for the duration of the session and ask your questions along the way, which our panel will answer. We can't give specific financial advice, but we can certainly give you general advice around your circumstances and question. So, as always, I'll introduce our panel of experts. Max, you've moved from last time. I'm sure you were sitting there last time. But,
well, I thought I was a bit too far left last time, so I thought I'd go a bit more in the centre. If I to the right, if I could have gone in the centre, I would have. But that wasn't.
So you're centre left now.
Yes, no, centre right, whatever. Yes.
Yeah.
Something.
So
like that.
I'd like to introduce Max Newnham and Bruce Brammall, our financial advisors. Welcome, gentlemen.
Thanks,
Good
Tony.
afternoon.
Good afternoon. Today we're going to be talking about the federal budget a couple of weeks ago, as announced by the Treasurer Scott Morrison, and we wanted to have a look at the measures announced. There were some measures, perhaps not as substantial as in the past couple of years in relation to superannuation and pensions, but all the same there were a number of measures announced, and we're going to go through those today, dissect them, have a bit of a discussion about what they actually mean when they come into effect. And then we also want to have a look, given where we are right now, just before June 30, there's always a bit of tidying up to do before June 30, and also having a look at what's coming in after the next financial year in July. There's a number of measures coming into effect in relation to superannuation and retirement that, funnily enough, were announced in the previous budget. So without further ado, let's go into them. Max, thanks for pulling that list together you've got in front of you. Let's just go through exactly what was announced in relation to Centrelink, superannuation,
Sure.
and the various aspects.
There was some things that were a bit more procedural. One of the most pleasing things for me was a change to the Centrelink income test. Currently, under the income test, someone can have employment and be 65 or older or be of pension age. And the first $250 per fortnight is not counted as income under the income test. The problem is, and that's to a maximum, I think, of 6,400 or 6,500 a year. The problem is that only applies to employment income. So, as has often been the case in history, small business owners, people that are self-employed, were disadvantaged because if they earned their income from the sweat of their own brow, all of the income was counted. But under this change from July 1, 2019, they've actually increased the amount you can earn to $300 per fortnight, and it's $7,800 per year that won't be counted, and they'll bring in the self-employed people to that. So that can be a major benefit for people to at least end up possibly where the income test ruled them out totally from an age pension. They might have been just under from an assets test point of view, and they ran their own business. They might have been consulting. It might be all sorts of things, and it might be very applicable to a reasonable number of our subscribers. It now means that the first 7,800 of that sort of income won't be counted.
Was there something in there around an exertion aspect? Because I wasn't sure what that actually means.
No, I'm not sure about the exertion. The interesting thing was, and there is the superannuation change, which is a major change, and it's going to open up some really good tax planning options, and that is that currently, to be able to make a super contribution and you're 65 or older, you must pass the work test, which means if you want to cease work and you're doing it part way through a year, to be able to make a tax deductible contribution or to make non-concessional contributions, you've got to do it in that year, which means that if you are selling assets that have capital gains, those profits get added on top of the rest of your income, and the amount you can contribute may have been decreased by compulsory employer super contributions. What they're going to do, and it seems to be that it's the lessening the pain of these reasonable benefit limits, the transfer balance caps. So they're saying now that in the first year after you don't meet the work test, you are going to be able to make contributions. So therefore, from a tax planning point of view, people will be able to work all the way through a year, maybe 65, 66, 67. They would then end up ceasing work in that year. And then in the following year, when they don't have any employment income and possibly only receiving tax-free superannuation pensions, they can then do some other things like selling an investment. The capital gain gets added on to nothing. You can make the $25,000 deductible contribution and get 100 grand into super. So that is, I think, a really good part of the budget.
And this one will get even better as the years roll on, because the 5-year catch-up limits will allow you to do that. So if you're turning 68 and that's when you finish work in 2021 or 22, and you've got 3 or 4 years of the 5-year catch-up provisions which kick in for the first time on 1st of July this year, and you've got that capital gain, you haven't made more than $10,000 a year worth of contributions in that year. After you finish, you might have your $25,000 for that year, plus you might have still $15,000 for a couple of years going back that you can contribute to super, get the tax deduction for. Again, you've got to be under $500,000, but $500,000 in your super fund. But there will be growing benefits to this over the years, thanks to the 5-year catch-up rules.
Yeah, I think that's good actually, because just having that extra time to put money into super at the end now will from next year anyway will be good. Yeah.
There's a couple of things that you could classify as sleepers. One of them is talking about, and it's under the guise of being able to consolidate super easier by giving the tax office the ability to, if there's a balance of a super fund member goes below $6,000, it automatically goes across to the tax office, and we know how generous and loving the tax office is, that they can then consolidate the super into other accounts. That altruistically and from a point of view of looking at saving people money from their administration fees, you can make a case for that. But for some people, especially with self-managed super funds, and Bruce was telling a story before about how a client was going to be horribly affected by a transfer from an industry fund or a commercial fund that was only kept for insurance purposes. You could face this unless someone's very careful. If they've got a super fund that they put some money in at the start and the main purpose of the fund was to provide insurance, if the level of their super balance drops below 6,000, before they know it, that money could have been taken by the tax office and they're suddenly under or uninsured. So that's a real sleeper.
It's scary on a number of levels to me on this one, and I've had clients in this situation. But if a fund goes below $6,000, but you've specifically kept it because there's a couple of $100,000 worth of life and TPD insurance, if it gets transferred to the tax office, at that point it will generally be stripped of the insurance. If you've got multiple funds that you're doing this for, you could lose all of your insurances. I had a client who was in their 20s, had suffered cancer, came to see me after this. They had 3 industry funds, all of which had a little bit of insurance, somewhere between $100,000 and $300,000 each. If you added them up, they were actually the amount of insurance that I wanted to have, if not the quality. But all of them, because she was in her 20s, not very big balances in any of them. And I told her this 7 or 8 years ago, if you ever get a letter from any of these super funds saying your balance is about to run out, we'll be closing your fund, call me and tell me immediately, and we'll get some money in there to make sure that these insurances stay active, because the client had suffered cancer, was going to struggle to get insurances, had a young child. This is going to affect a lot of people in their 20s, 30s and 40s, but it is also going to affect a lot of people who are older or who have self-managed super funds, where they do keep $500,000 or $1 million worth of life cover with their old industry funds, but they just keep $10,000 there or $5,000 there because they'd rather be investing the majority of their money, and that fund is literally just sitting open. So what the government's going to do is make you opt in for it in the future. We don't know how it's going to impact on people affected now, apart from the $6,000 rollover to the ATO, but you're going to have to opt in to keep this cover on the insurance side, or they'll strip it out. I can see people being stripped of their cover or the money rolled to the ATO, and all of a sudden they die. They moved house. They didn't get the notice from the super fund. Something happened where they didn't get the opportunity to opt in to keep this cover. They die. There was $1 million worth of cover there. the partner knew that there was some life insurance somewhere. Oh, hang on a second, it was rolled to the ATO 2 years ago. There's no $1 million worth of cover anymore. And the ATO won't be offering advice on this. They won't be asking you, I doubt, to or helping you make sure that there isn't wanted insurance in some of these funds. It's just got danger written all over it.
It'd be interesting to see that and this is where, depending on the consultation process they go through, it would make sense that if the legislation was passed, that if there is a balance falls below 6,000, the tax office has the ability to end up consolidating it. But if there is insurance attached to that account, that the member must be notified before that happens. And I mean, it's a bit like another budget policy that I'll be talking about fairly soon, that these budget thought bubbles come up and then they go through a consultation process. Because I mean, if you look back at what the original idea for making our superannuation system more sustainable under the previous treasurer, which was all retrospective, and it was the worst changes to super almost that I can remember. But then by the time it had gone through the consultation process, we ended up, which I think in the end the changes weren't that bad, that hopefully we'll have the same situation. Like one of the thought bubbles in the budget is this idea that, and I was actually speaking to someone who is in federal politics, and was saying how that this measure to have self-managed super funds only be required to have their fund audited once every 3 years, if they get 3 years of clear, non-contravening audit reports, sounds all right, but it's a recipe for disaster on two levels. One, we could find that the ranks of the homeless sleeping in our streets will be swelled by all of the unemployed auditors, because you can imagine running a business where you can only work once every 3 years if you have a really good client base of complying super funds. That's the one possibility. The other possibility is that the auditors, where in the past there's been a reasonably good working relationship between accountants and SMSF administrators and auditors, and sometimes things can be in a grey area, and it may not necessarily be a strict contravention. It's going to be in the auditor's interest to make sure, if their livelihood is threatened, that they're going to want to find at least one contravention at least once every 3 years for all of their super funds. So to me, what I think needs to happen is they need to change the requirements for auditing a self-managed super fund. Currently, the standards that apply to auditing a self-managed super fund are the same standards that apply to BHP. So there's a lot of extra work, a lot of ticking and all of the rest of it that goes on that is not really applicable. In the end, the audit of a self-managed super fund should end up making sure that all of those major arm's length transactions, in-house assets, making contributions to that they aren't contravened, that they on that basis scale back and state specific audit standards for a self-managed super fund, rather than making it like at BHP, and that will hopefully create a situation where the cost of auditing super funds will reduce.
I mean, that could be one way of doing it to simplify it.
Yeah.
I mean, on the surface, you'd have to say that instead of having to spend on an audit every year, you're doing it every 3 years is good for the client, but there could be complications, and as you say, the superannuation law is very complex, and if you do contravene the law, then you're up for pretty stiff penalties.
The third possibility, which you've just alerted me to, is that audit fees could triple. If you're going to only end up auditing a fund every 3 years because it's exemplary fund, that's the situation.
Possible.
So
sorry, just before we move on, just while we were talking about the whole insurance thing, I mean, I understand what you're saying, Bruce. It has a lot of complications, and the opt-in, opt-out. You don't want to get caught with no insurance, especially if you need it. But on the other hand, I can sort of see for low balances that it's just eroding away that.
Oh, absolutely.
Capital.
Look, the rules that they're doing is if you're under 25, you're going to have to opt in. You're not going to be offered automatically insurance anymore. That makes sense. How many 22, 3, 4, 5-year-olds need insurance? Well, unless they got married, got a mortgage, have kids, not really. It's usually in their later 20s, early 30s that those financial commitments and whatever have come into play for them. That's fine. People who have smaller balances, yes, it is eroding it away, but to a degree. But the insurance is often needed, and just stripping it off, on an opt-in basis, it just concerns me a bit. Not for the people who are coming into the system now. The bigger concern for me, the change that they're making going forward. Under 25s, if balances fall below 6,000, under 25s, I don't have a problem with. But if the current, particularly a lot of self-managed super fund Eureka readers are going to have those balances that those industry funds, they still have their insurance. A lot of people do. We still recommend it a lot for clients. Now, if the balance falls below and the ATO grabs a hold of this because they have a mandate to, then people could lose a lot of insurance. The general idea of what they're trying to do is fine, but there needs to be some consultation, and what Max had said before would be something that needs to be thought about, and that is if the ATO moves to roll over a fund that has less than $6,000 in it, there needs to be some question asked. Is there insurance on this? Was it automatically accepted insurance? As in, there was no underwriting being done, in which case it might just be one that was thrown on the account because, under the opt-out rules. But a second question could be, did somebody actually apply for insurance on this over and above the 2 units that they were given by their industry fund? Yes, we can say, yes, they did apply. They applied for $500,000, $700,000, $1 million, whatever it is, but they physically applied for a high level. In that case, no, we don't want to touch this one, but we do need to write to the clients and say, your balance has fallen below $6,000. Here's your first opportunity. We're only going to offer you 2 more. There's some work that needs to be done. There's some safeguards that need to be put in place because the ATO does not always get this right.
Really? I've never heard that.
The other thing on that whole issue is, the government says, we're going to, use the tax office to reunite people with their super. Well, this has been going on for years. And they've got $14 or $15 billion.
Very, very dangerously also. The example, I have written about it for Eureka if anybody wants to go back and look this up. The clients of mine in their early 50s, we set up some proper insurance at, let's call it Fund B, and their original fund was Fund A. About 3 Januaries ago, we get an email from Fund B saying your client's rolling over from Fund B back to Fund A. We've called the clients and said, we called the Fund B and said, what's happened here? Well, there's a rollover form, we need to roll it back. We've called the client and found out eventually what had happened was the ATO had sent a letter to the client saying, we noticed there have been no contributions put into Fund B for a period of time, 3 years, whatever it was. Sign here and we will roll over Fund B into Fund A. The client, it's coming from the tax office, duly signed and returned, and then this started the process of the rollover. Unfortunately,
lost their
fund
insurance.
$900,000 worth of insurance that was sitting there that we deliberately taken out here. Now, thankfully, we were able to stop the process happening and get it fixed, and the money had actually started moving, but we got it back and were able to keep the insurance in place. She subsequently died about 15 months later, so that literally would have cost her husband and her children $900,000. The ATO didn't ask about whether there was any insurance there. They didn't ask any questions about it. They just said, this fund hasn't received any contributions, sign here, send it back, and we'll roll it over. Now, this client had been sick on and off for a period, and it was about a month, in fact, weeks after she signed this and sent it back that she found out that she had the cancer that had come back and took her life 14, 15 months later. The ATO doesn't look at any of this sort of stuff, and it's potentially disastrous.
And you don't expect them to. And again, you've got this problem with the people who write the legislation have a very loose grip on reality. And I mean, I tell the story, being at a budget and asking a Treasury official, what does this tax change mean? And he proudly said, look, I only write the stuff. It's up to the tax office to understand and interpret it, which when you come from that sort of a basis, But one of the things, it does raise a couple of points, that if they end up having a situation where they can take the workload off the tax office, that they would communicate with the super fund saying, hey, you have a member's balance has dropped below 6,000. It is our intention to force a rollover unless there is insurance involved, and if there's insurance involved, you need to send a letter to that member stating that, hey, we've received this notice from the tax office that we're going to be having to roll it over. There is insurance in this. You need to make a decision and get advice.
You need to opt in, and that's sort of what they're saying.
Yeah.
But we haven't seen any of the detail yet on what the ATO is going to ask of the super fund. So they're just going to say $6,000, bang, that's it. Send it over to us, or are they going to have this sort of back and forth between ATO, super fund, client, customer? There's some safeguards that need to go in. None of which details were in the budget, and hopefully is thought through, and some proper processes are put in place so that people don't lose. It's not just about insurance. But a good portion of it will be. Yeah.
Well, hopefully
right, that's
process.
Moving,
now there was some procedural things. What the budget said is they're going to more strictly police the requirement for super funds to have a notice of intent to claim a concessional tax deduction, so that the person who's made the contribution can claim the tax deduction. I suspect that maybe, and I can't imagine it'll be with industry funds or commercial funds, that there might be self-managed super funds who have been a bit lax in some of their record keeping, where they've made the concessional deductible contribution, not worried about the follow-up with the actual completion of the paper warfare, that they're saying we're going to more target this. So it's a wake-up call for people with self-managed super funds. If you're going to be claiming a deduction, make sure that you have signed the letter, which will be mass-produced in most cases, saying, yes, I intend to claim the deduction. Another thing was which could be potentially bad for self-managed super funds. It's a bit like most of the regulations relating to super are aimed at people who are members of a fund where someone else is managing the money, and it's designed to protect them. In self-managed super funds, the people who are the members are managing their own money. Sure, they may be getting help. One of the measures that they're looking at bringing in is that it'll be a requirement for super funds, for super fund trustees, to develop a retirement plan for members. It's a bit like you've got to offer them the insurance, which is always something that you always got around with documentation. Now, if it's going to apply to industry and commercial funds, great. But if they do it carte blanche across all of the superannuation industry, it's going to be another useless piece of paperwork that the self-managed super fund trustee is going to have to prepare. So it'll be interesting to see what comes through on that. There is the
move from 4 to 6 members.
Yeah,
so
that's
and it's going to be an interesting one. So self-managed super funds, I confirmed it in the budget. We'd written about it a little bit before. They're going to allow self-managed super funds to go from 4 to 6 members. There are positives and negatives about it. There are a lot of potential negatives about it. The positives are mainly you can have, mum and dad can have the 2 kids and their 2 partners potentially in it, or all 4 of their kids, or something along those lines. The downsides of it are going to be the extra risk that comes in for members. If you've got, at the moment, mum, dad and 2 kids, then the parents can vote as a block, and the kids could potentially vote as a block, and who knows what's going to happen in that situation. But if you've got mum and dad, 2 kids and their 2 partners, and there's voting as a block, then there's going to be problems, and the parents could get rolled on.
Choose your children very wisely.
Choose your children. Yes.
I think in one of my last columns that question was asked. I said, well, you've got to look at the costs and benefits. When I look at the benefits of having your children in a super fund, I can't see too many benefits. You may be saving them the $80 a year that they may have had to pay if they're in an industry fund, and therefore the cost of the administration for the self-managed super fund doesn't go up. But the cost of having them in there is you therefore have to be more careful in relation to the investments. You could end up having a situation if there's a problem within the family, the kids can come along and say, well, hold on a sec, you've never told me that you're investing in futures or things like this. To me, the KISS principle should apply to most situations. And why would you make something that is beautiful, which is a two-person self-managed super fund, which is designed to help people accumulate assets for their retirement and to pay them a pension in or an income stream in their retirement, why would you complicate it by getting other people in? The only reason I could think of is if you have a family that are involved in a business and the business wants to buy some real estate and the value of the parents' superannuation balances isn't sufficient to buy the real estate, bringing the kids in, that it's a, starts off as a one asset thing, that could be a possibility. But there aren't too many, situations where I could come up with where you get a great benefit by bringing the kids in.
It's not going to be widespread. Look, less than 10% of self-managed super funds at the moment have 3 or 4 members anyway. The number that would want to have a 5th or a 6th member in there is probably pretty small, really. I mean, it's not going to be something that's taken up en masse, I wouldn't think. But also importantly, you can't just do it. You can't just add in, from July 1 or whenever it kicks in, you can't just add a 5th or a 6th member. You probably need to update your trust deed. You probably need to update your constitution if you've got a corporate trustee. There are a lot of things, and apparently also one thing that I'd read was that in some states the law is actually going to need to change on this, because there are state laws that
define a self-managed super fund as well.
Yeah, as well as federally, or the number of members. So it's certainly not going to be something that you can rush out and do from July 1.
Do you think that'd be a good justification for getting rid of the states and we just have a federal system and don't worry about the states? Think of the money we'd save.
Well, Jeff Kennett was always trying to do help himself out of a job and get rid of the second layer.
Get rid of the states. Just have good. Oh no, hold on. We've got problems with councils that are all that. No, probably maybe not a good idea.
Well, WA still wants to secede, I think, from the rest of Australia, which makes
are they still part
sense.
of us? I thought they'd gone ages ago.
Last time I checked.
Oh right, okay. What would you? Oh no, yeah, that's right.
I'm from there. So.
Oh, that's right. Okay.
Yeah.
Right. Oh, really? That explains. Oh no, I won't go there. One of the other things is that it's a great change. That's not going to affect many people. Is in relation to compulsory superannuation contributions, where you have someone who's employed by a number of employers, and especially if they are on a very good high wage, that now people that are in that place will have the ability. Let's say they've got 3 employers, and let's say with one employer they're on $280,000 a year, and then they have other employers that they do some bit of work for that may be only $30,000, or depending on what it is. When this legislation goes through, a person will be able to fill out some form and give it to the employers that are the lesser from a point of view of the superannuation point of view, that you do not need to make a compulsory super contribution for me, because under the current system, because it's compulsory, you have people that are automatically caught in an excess concessional contribution, especially now that they've dropped from 35 down to 25. So, it's a way of, we're saving ourselves some money by reducing the concessional contribution cap, but we're going to increase the workload of the ATO by having to send out all of these excess compulsory, excess concessional contribution things. So that is I think a step forward, which will make it easier for some people. It's not going to be, maybe 5%, maybe less of the population, but it is a good thing.
All right, should we keep going through the list?
Yeah, the next, I think that pretty much does all of the super ones. I couldn't see much there. The other one is income tax, which will have a benefit for people that have been put into this situation of having an excess pension balance, so that they've gone over the 1.6 and they've got money in accumulation. And basically what they're doing is they're introducing a new low and middle income tax offset. It will start for people who are on less than $37,000 at $200 a year. So that means someone in that case would get the low income tax offset, which I think is $450, and then they'd also get the $200 of this middle one, so that's $650 tax offset, and then that lower middle income tax offset increases at 3 cents per dollar up to a maximum of $530, which is equivalent to a salary of $90,000, which is what they're saying they're going to make the new threshold at where the 37% tax rate. Currently the 37% tax rate kicks in at 87.
Yep.
So I think they're going to be looking at increasing that threshold to 90.
They are, but quite a bit further down the track.
No, the 90 happens now. The one that you're talking about down the track is that what they're going to be looking at doing is cutting out the 39% by about 2020 something or other,
Yeah,
and that we're only going to have the 32.5% tax rate.
That's it,
that'll apply all the way up to 200,000, whatever they make is the where the top one comes in.
Yeah.
So where that's going to be a benefit for some people is where, and I think we've had discussions about this before, where you face the choice: do I leave my money in my superannuation fund in accumulation because I've been forced to take it out because I can't have it in my pension fund anymore, or do I take it out and invest it elsewhere? This new offset will mean that people can have a higher value of assets outside of super, earn income on those and not pay tax, whereas if they leave it in accumulation, they're paying 15. So it's going to have broad effect on anyone who's a subscriber that pays tax now, but it could have another benefit for even if you're not paying tax at the present, or you've got this situation of having the excess in the accumulation account. So that'll be an interesting one from when it comes through. This is more of a measure to clamp down on what has been an abuse of a privilege. Under current legislation, when someone dies and they set up a testamentary trust and assets pass into that trust, you can have child beneficiaries, in other words, children under 18 years of age, and they are treated as an adult for income tax purposes. It's where you have a young couple with young kids. It ends up being a very valuable strategy to make sure that if the main breadwinner dies, that the after-tax income that's produced by the family is maximised, because you can therefore have this testamentary trust distributing the income amongst the children and then the wife and things like that. It would appear that some people have been sneaky and bringing some other assets that have effectively materialised after the person's died, and there must have been a hole in the law or something like this, but now they're going to make sure that the only time that there is the advantaged tax treatment of distributions from a testamentary trust, it only applies to the income produced from the original assets.
So you have to nominate what assets, exactly what assets may be in the trust deeds of what's going to end up in the testamentary trust. If you leave something out, then and want to add it in, that's fine, but it's not going to get the tax-free treatment.
I don't know how they're going to do it. To me, it wouldn't be nominating. It's going to be a bit like the transfer balance cap, is that once the testamentary trust is started, the value of the assets may end up being 1.4 million, as long as those assets are held forever. I don't know how they're going to do it, but it may be that with the formation of the testamentary trust, and it starts off with its original assets, whether they've been transferred in or whether it's cash, that it's a bit like a contribution. The contribution that sets up the testamentary trust will be known at that time. And that trust will not be able to accept any more funds being put into it, I suspect. It's going to be interesting to see what happens with that one. And then one thing that was a help for small businesses, there was the budget. I think it was the budget when the first version of the changes to super came out, where the $20,000 instant write-off for small businesses for assets, for an asset costing less than $20,000, they could get an instant deduction in the year that they purchased it. Originally was going to be only applying up till the 30th of June 17. it took them so long to pass that legislation that they gave everyone an extra year that was originally running out on the 30th of June 2018. They're now extending that for another year, so it'll apply to purchases from the 30th of June 2019. And one that could affect our clients or our subscribers is, under current legislation, if you buy a block of land with the intention of building a rental property on it, you are able to claim a tax deduction for rates and taxes on that property and the interest on the loan, even though you're not producing income. So it's an automatic write-off, as long as you can show you have the intention. I think, again, that's probably been abused by people who may be land banking or doing all sorts of things, or whatever they're doing. So from whatever this change to the legislation will apply, you will not be able to claim tax deductions on vacant land, no matter what your intentions are, and you can only start to claim the deductions once you have a structure on the land. There is an exception though. Businesses will be able to claim a deduction for vacant land. So that the tax rules apply, and that could be easy. I mean, a very good reason. You might have a business that's bought the block next door because they need to expand. It's a holding cost for the business, and so they will be exempted from this change.
Okay, that's an interesting one. I didn't pick that one up in the budget. So
yeah, there was a couple of little hidden gems in there, and so yeah,
it always is, isn't it?
Yes, yeah.
The other one, which we can just briefly touch on before we move to questions, is the pension loan scheme. There's some changes in that.
Yeah, I didn't include that one because I got all excited when I first saw that about the extension. Currently, I think people, and I didn't fully understand it, was saying we're going to make it easier for people to apply for the pension loan scheme. And this is a part of this work test situation, because if you're getting even some small part of a pension, you can go in for the pension loan scheme. And the pension loan scheme, I thought, great, it's like a reverse mortgage. You can borrow from the government to help pay something, and the government has an interest in your property, and I think they apply something like a 5.3%. And I think reverse mortgages, it's hard to get them under about 6. You would...
Be around there. Yep.
Yeah, so it's a lower interest rate than the market's paying, and I thought that's good, because I had a client that had been in business, owes the bank $50,000, wasn't very successful. The bank is saying, hey, to just clear us from our books, if you can come up with half of the debt, we'll call it quits. Trouble is, he's got a house, he doesn't have much income where normal lenders would be happy to lend it to him, and I was thinking, oh, this could apply. But the money that comes through this system is not a lump sum. All effectively that you'll be able to do is, and it applies more to people without the big assets around them, is that you'll be able to use the value of your home to get up to 150% extra to fund your lifestyle of 150% of the standard pension. So if the standard pension is $20,000 a year, someone can end up saying, well, I'm going to get $30,000 a year to make my lifestyle that bit easier, with a loan building up over a period and with various things. So it's going to be of a benefit, but it's not going to be a true reverse mortgage type situation where you can take a lump sum and do something with it.
Yeah. We won't do it today, but I wouldn't mind in a future one talking about these home equity release type products that are coming out to the market.
We don't know a mortgage broker specialist, do we?
I think
that would be a good one to look at, because there's just so much in there, and there are a lot of wolves out there.
It's an interesting type of product that's coming onto the market. And
in fact, it's gone the other way. I saw there was a huge influx years ago, but then it seems to have shrunk back a bit, hasn't it?
An old business journalist colleague of yours and mine, Tony, talked about these things being around the 80s and then being killed off with the recession we had to have, and they sort of disappeared for 15 years or so and then started making a comeback maybe 15 years ago. But no, there are a lot of providers out there in the market now that are able to do it, and you need to know what's what and the costs involved with it. You need to have chats with your children about what this will mean for their. We don't have to, but you probably want to have a chat with your kids about it. There's a lot of understanding that needs to be had around this, but I think it is going to become a bigger and bigger product to be used by, as we go into the future. It's not a massive industry, but the number of people using reverse mortgages is certainly growing.
Because there is that other option. I'm trying to remember the name of the crowd where they allow people to have slices of property at the present, where you can end up, I forgot the name of the business, where...
I know the name, but we won't go into names. But
no, but then, so that business idea by the people who started it, and it's gone off on being able to effectively, it means that people can have a fractional part of a property, and rather than, it's a bit like a unlisted direct property trust. It gives people the chance to put a property up that a lot of people can come in and have a share of. There's rent paid. I don't know how it works from that point of view, and it seems to be working. Originally, the idea was to have this for someone who owns a house, who could sell part of their house to someone in this fractional point of view, like the reverse mortgage. And that may be an area where, if they can get that off the up and going, would be a very good alternative to the reverse mortgages.
The only we wrote about this a couple of weeks ago, but we looked at a couple of these schemes that are out there, and investors who bought in a year or two ago are actually looking at capital losses at the moment because property values have declined.
But that's property. I mean, you can't blame...
So the unit prices have gone down.
But you can't... If they had enough money to buy the property in their own right, would have happened anyway. So interesting enough, if they've spread it over a number of properties, it may be a great way to diversify or reduce risk by diversifying over a number of properties. I think in that case, it's not the ability to have fractional interest in a property that's the problem.
It's that's not the problem.
No, it's just a problem with, and if people are bleating because it's not worth what it was, well, welcome to the property investment world.
That's the realities of the market. Anyway, let's move into some questions, which I've printed off actually. Some of them are related to the budget and some of them not. But we were talking about this just before we went on air. This question is around someone who's got a couple of $1 million in a super fund. They don't want to manage their money anymore, so they pretty much want to get someone else to do all the heavy lifting on things. But there's the issue around people who have got quite a bit of money in super, and there is an option really for people to roll some money into a property, principal place of residence, have a small amount of money in super, which still qualifies them sort of under the assets test rules for the full age pension or most of the full age pension, and they can still generate, some income. So the question is, is that a reasonable strategy?
Not really. I think you've got to look at each case on its facts. If that means that you're going to be going and changing, or let's say you've got 1.2 million sitting in your super fund, which means you certainly don't qualify for the pension now, and you're living in a house that's worth 600,000 and it's a bit down at heel, and it'd be nice to upgrade. Yes, they could take out, if they've met all of their conditions of release, they could end up taking 800,000 out of their super fund, upgrade to a 1.3 million home, have 400,000 in super, and be getting, almost a full pension, or they'll be getting a part pension, which gives them all of the other things. That's all well and good, but then it's an interesting, if they were doing it 7 years ago, it would have been a very smart decision, because they would have ended up paying $1.2 million for a house that's now worth 2.4. But doing it at this time of the property cycle, I'd say, well, you might be buying something that's going to inevitably either be stagnant for a long time or go down in value. And if you're going to be putting the $800,000 into your house are you overcapitalising and never going to get it back? I think in those cases, it's hard to say, yes, good or bad idea. The important thing is to go through each of those options, put it down into, here's the benefit, here's the cost. Here's the benefit, here's the cost. When you look at any of your alternatives in those two things, cost benefit, you're going to come up with, you know, what's going to be best for in that situation.
If you can't eat your house, and if you pull all that money out of super and use it to double the size of your house or whatever it is, and pay a wad of stamp duty to do that, you will get to a point where that, to continue with Max's example, the $400,000 that you left in super is giving you a small pension, and as your super fund balance falls, your pension fund, the age pension that you receive is increasing. But you'll get to a point where, you know, all you've got left is the full age pension, and the $800,000 that you tipped into your home is gone unless you do something like a reverse mortgage or pension loan scheme, and incur another lot of, you know, sales costs and stamp duty, and all of a sudden you've blown up $200,000 or $300,000 upgrading and then downgrading and downsizing to get the money back into super. I mean, it's just. You said millions. The question was millions in super.
2 million.
2 million in super. There's an element to, you know, wanting to improve your lifestyle, get a better home, to get under the limits so that you do get some sort of an age pension. But as you spend down your assets over time, you'll eventually get into that zone anyway, and then your age pension will start at virtually zero, and as your assets continue to go down, your age pension will continue to go up. I'm not a huge fan of going and spending huge wads of money on your home. If you're this far from being able to qualify for some sort of an age pension, you know, within $50,000 or $100,000, and you need to do $50,000 or $100,000 worth of renovations to your home to improve the value of your home, funeral bond, fix up the kitchen so that it will last you, you know, your 30 years through retirement, the bathroom, to get that up to scratch. That gets you under the limit, and that's great. But and that's some of the ones that will, you know, add value to your home without you having to, you know, sell it or move out or upgrade or downgrade or whatever. But getting loads of money to
go on a nice holiday.
And another part of that question, though, is, and it's interesting because the impression was, hey, we've got $2 million. We've been very hands-on managing our self-managed super fund investments, and we're getting tired. We're thinking we can tip the money out of there, put it into a house, get an age pension, or the other thing is, what's the other option? Is that you then, if it's getting a bit too much to manage it, and this is an easy thing to say, but then you need to look for an advisor who will advise you on the managing of those investments, but is someone who has not ever taken commissions, because if they've taken commissions, I suspect their advice will be tilted towards the areas where they traditionally have gone. I had a meeting with a client yesterday who has 1.2 million sitting in a super fund and wondering what he's going to be doing. He doesn't want to be as hands-on. And it was simple. Found out that money was invested through a wrap platform. The wrap platform's great for the advisor because it makes their life easier. They don't have to, you know, their administration is cut down, extra profit for them, but it adds a degree of cost for the client, that they need to find an advisor that specialises in putting together portfolios that are to the advantage of the client, not the advisor. And I mean, I've got lots of clients, you know, we look after about 70 self-managed super funds. You know, we've got 30 of those that we assist them with the investments, and some of that 30 do a lot of still their own investing, but some of them just say, look, no, you just invest it for us, we'll be happy, you know. So I think you've got to look at it as if they don't want to do the work, it doesn't seem to me to make sense to get it out of super. Find an alternative to be reducing that. I mean, the other thing could be, and I'm seeing this more and more, I've had a few people say, well, I've got this money here, it's getting too much, I'm thinking I'll put it into another fund. In that case, the low cost, well-performing option of something like an Australian super or one of the other well-managed industry funds could be another option.
I mean, at 2 million though, you're often going to find that you find an advisor to give you the investment advice, like someone like Max or myself, who can do that and still do it very cheap. You tip $2 million back into even an industry fund that doesn't have some sort of cap on fees at $1 million or whatever, and the cost is actually going to be quite significant.
That's why Australian Super has a cap of $750 per member.
Do they? Okay, right. So some of them do, some of them don't. But you'll often find that an advisor will be able to give you advice that looks like you've got a fee cap at $750 or $1 million or something like that, but it still allows you to hold on to some of those assets that you've built up or do have a particular interest in, rather than selling up industry fund or whatever it is and having to go with some multi-manager that you may or may not like or agree with, that may or may not perform. So
subscribers in that case really need to see a professional who specialises in advice, not placing investments, and that's the differential. And then have a look at each of those options and make sure they are told, here's the cost and benefit. I keep going back to that. I'm an accountant, sorry, but look at the cost benefit for each of the options and work out what's going to be best for them.
Yeah. Okay, good. Next question is around pension drawdown. So someone with 1.6 million balance, you've got your minimum pension drawdown depending on what your age is. Will the 1.6 million be used as the yardstick forever, or as the balance declines, the drawdown limit is on the balance?
It's always on the balance.
It's always
on the balance.
So
always on the balance.
And it's determined by what age you are. So 55 to 64 is 4%, 65 to
74,
5%. Then in each 5 years after that, 6, 7, 9, 11, 14.
Goes up to 100%. No, it goes
11,
up to about
14.
So nothing's changed on that score.
No, but it's your balance, which will most normally be at the start of the financial year.
All right. This is a bit more of a technical question. We might have to come back to the route unless you both know the answer. But could you please clarify which financial year is the last year to be able to claim the ATO's medical rebate for aged care expenses?
It's about 2013, 14. It's about 2004, 2013, 2014. It's a good number of years ago. Because I know we've been doing the tax returns for a long time, and people say, "Oh, I've spent this much." Sorry, you should have spent it 3 or 4 years ago. So no, it's about 3 or 4 years ago.
Right. Okay. The question sort of implying that they're still able to get this rebate.
No, only for prosthetics. So if you want to cut a leg off and get a tax benefit by getting that funded through a tax offset, that'll work. But apart from that, no.
Listeners, please do not do that.
No, this was not advice. It was a rhetorical statement.
Well, as we stated, what we're offering is general advice.
General advice.
Not specific advice.
We're not saying which limb either. No.
That's right. The RTO always wants an arm and a leg. Okay, next question is, I'm age 66. I sold a business with a building, having owned it for 17 years to work part-time in another job. I'll receive the 15-year CGT exemption. I'm working for 40 hours per month. I have over 1.6 mil in my super. I understand I can still put the money into my accumulation account as part of my super. Is there a time frame it has to be put into super after the sale of the property?
I think they fall at the first hurdle. The 15-year is a retirement exemption. My understanding is to claim the 15-year exemption, which means it's up to about 1.3 million, you won't pay capital gains tax on, and that 1.3 million could go into super, is you must be intending to retire.
Right.
So if you're not retiring, the 15-year one, on my understanding, is not available. You can still go for funnily enough, the retirement exemption, which means you are able to claim an exemption up to $500,000 of an asset, of a capital gain, which if you're over 55, you don't have to do anything. If you're under 55, has to go into super. But when you look at it, if as long as the capital gain hasn't been made in a company, it's been either made as an individual or as in a family trust, someone can potentially make a $2 million gain on the property. They get the 50% general exemption, which brings it back down to $1 million. They get the 50% active asset, which brings it back to $500,000. Then they can get that into super. So no, I have a problem with this person saying I've sold my business and my property and I'm still working. I don't know. They need to speak to someone who specialises in this and confirm whether they can get that exemption. And it's a very complicated area of law. I'm speaking to someone yesterday who given some advice to that they should be getting the retirement exemption for $500,000, and they used a tax agent, not an accountant. They got the advice, they went away, tax returns. Like they said, oh look, we've got the money now. When should I be putting it into super? Have you lodged your tax return? Yes. Well, you're too late, because under the small business concessions, you must, to claim the retirement exemption, have the money go in at the time you make the choice to claim it, which is at the time you lodge your tax return. So the money has to go into superannuation before you make before you lodge your tax return. Effectively, you've got to make sure that if you're lodging on the 15th of May, the contribution must have gone in by the 15th of May. If you do it after it, you don't get it. So it's a very complicated area.
All right, we've got time for one more question. I'll take it from the screen here, which I'll bring closer to me. So, will super, actually this is probably quite a short question, but will super contribution limits increase from 2018-19 after indexation for average weekly ordinary time earnings?
Possibly.
No, not this financial year.
But who knows? We might have a sudden spike. The chances are no, because it's going to be done in 5,000 increments. So no,
it's not going to happen. The first one, it's linked 2030. There, people. No, the answer is it won't happen in the next financial year, FY19. It probably won't happen until FY21 or 22 or something like that, when inflation has kicked in to drag the $25,000 concessional contribution limit up to 30, which I think then has a flow-on effect for the NCC limits as well. So it's
not even the transfer balance cap, because that's done in $50,000 lots.
$100,000
$100,000 lots. On 1.6 million to get up over 100,000. Is that on a WOTI or is that on inflation? I forget which one it was.
Not sure. Neither of which, both of which are anemic at the moment. So,
so there's going to be a while before the 1.6 increase.
Well, 100,000 on 1.6 is only 6%, 7%. So it's probably a 3 to 4 year period from when it started.
Okay. Just before we do sign off, quick one. What are the top things that people need to do before June 30? One each.
Find a good accountant and financial advisor. Definitely. That's number one. No, assess. You've got to be, if you're in pension phase, make sure you paid your minimum pension, because if you don't, your super fund will lose the exemption from paying tax on the income.
Yep.
And for me, make sure you maximise your contributions using the new rules that allow everybody to do it, so even employees. Anybody can make, under 65, can make that contribution to super now. If they've employed with a $100,000 a year job and their employers put in $9,500, then they can put in up to $15,500 into their super fund, get the tax deduction for it, and have essentially the same benefit they would have received had they made those contributions during the financial year as a salary sacrifice or something. So it's a massive win, and the next, the time for the remainder of the financial year, about 5 weeks, I think we're going to have a surge in people doing this, and that's probably the top thing to consider for people in accumulation phase versus what Max has just suggested for those in pension phase.
The only additional thing I'll add to that, if you're 65 or older, if you've met the work test, you can still do it too.
Correct, yeah.
So the beauty is that you can top it up so that you're making, or this is again getting the right advice, it may be better not to, so that you can end up carrying forward your concessional contribution and increase it and use it when you're going to have a big gain.
So you heard it here first, get good advice before June 30. And always afterwards. You've got 5 weeks to go from tomorrow. Thanks for joining us on Advisor Q&A, and we look forward to you joining us next time.